Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday the 10th of January. The new year just plods along. Lots of stuff on the go. I've been really busy lately, getting my hands on a lot of deals, a lot of opportunities. Very, very interesting. Something has changed in the marketplace. I'm seeing it right now. So as I just mentioned, I am getting a lot of opportunities for fix and flip and buy and hold down here in my area. Some good opportunities. If you'd like more information, please reach out to me. Some of you have, and I'm engaging. Some of you would like some more information. Email me, give me your phone number. We'll talk immediately. I got deals on the go right now that you can purchase and invest in, which is kind of fun. So again, contact me for more information. Also, with regards to short sales and my other real estate training products, some of you have again picked the pace up again. Let's talk about it. I think short sales will be big time for the year 2020. So also one more thing, please subscribe to my channel if you're not already a subscriber. We talk about all sorts of housing news here from an unbiased perspective, and I give my editorial and my opinions on what's going on. A lot of things can happen this year, so it'll be fun to see how it all shakes out. So today's topics, we're going to talk about housing signaling a recession, subprime back with a vengeance, third wave of post-recession distress, mortgage debt hits new records, mortgage rates, and New York is losing the migration game big time. So here we go. All right, so this article came out, and again, I'll post everything in the About video section, so you can go look at these articles online, verify the information in the comments that are in the articles yourself. All right, so housing data is consistent with the recession in 2020. That's the title of the article here. And basically it says over the past year, four housing indicators have moved in ways consistent with patterns seen in three previous recessions. So housing is signaling a recession. Despite optimistic talk from the Fed regional presidents, a St. Louis Fed study concludes housing indicators remain consistent with a broader slowdown in 2020. The key takeaways for this report was over the past year, there are four housing indicators have moved in ways consistent with patterns seen before in three previous recessions. These indicators are mortgage rates, existing home sales, real house prices, and the momentum of residential real estate investment. And a more recent housing data still point to a slowdown, albeit a less severe one than the Great Recession. So we are referring to the Great Recession as not the Great Depression, the Great Recession as the stuff that happened in 2008 when we had a major recession plus a massive housing bubble and burst. So please keep that in mind. So the number one, which was the mortgage rates. So essentially it's a 30-year fixed mortgage rates. And why this is interesting is the fact that consistent with earlier cycles, the average 30-year fixed mortgage rate has declined significantly, even though recession has not begun. So it's kind of like, it's almost like, hey, we're at the peak of the market, things are changing, things are dropping, let's get that last little push in before there are problems. So I look at that as somewhat of an indicator of what's going to happen. Two, existing home sales. So really, the pace of existing home sales relative to the recent trend rate continued to slow down during 2019, and despite a modest upturn in the third quarter, this indicator remains firmly in the range observed prior to 1991 and 2001 recessions. Now, in contrast to the Great Recession, the decline in home sales since dipping below zero has been much more moderate. So there's going to be some nuances comparing all the recession and with the recessions, but again, it still is an indicator that stuff happened before, we're seeing it again. Three, real house prices. Essentially, qualitatively, the recent behavior of inflation-adjusted home price growth relative to its recent trend rate is very similar to the patterns of the two previous indicators. It mirrors the run-up to the relatively mild 91 and 2001 recessions and is unlike the pattern just before the Great Recession. So again, there's indicators and some nuanced differences. We'll see what happens. And number four, contribution of residential investment to GDP growth. Essentially, despite some improvement overall in the course of 2019, residential investment continued to be a drag on economic growth through the third quarter, albeit a slightly smaller one than before. Of all four indicators, this one closely resembles the pattern seen before in the two relatively mild recessions versus the more severe Great Recession. So again, the Great Recession seems to be the anomaly. So it was obviously it was chaos. So there's it's obviously there's more pronounced issues happened, and I guess you could say more pronounced indicators were in that recession. The conclusion basically is housing indicators still signal a recession, albeit a less severe one than maybe we experienced in 2008, which we've all thought about that, going maybe the Fed's stepping in, trying to prolong and pump life into the marketplace as long as possible. So we may not see as hard a crash, and we're probably going to see regional issues as opposed to national things taking off here. So the value of leading indicators, from housing variables to the slope of the yield curve, is that they offer an opportunity to prepare for a possible economic slowdown or outright downturn. A recent example is the Federal Reserve's dramatic turn from a program of monetary tightening in 2018 to an easing of policy in 2019. So yeah, they felt the growth was going, let's raise rates in 2018. Oops, wasn't quite what we thought, so we're going to ease on the rates and the policy in 2019. So the Fed eased monetary policy and mortgage rates plunged in advance of each of the 3 previous recessions, yet the economy still went into a downturn. Thus, the value of leading indicators may lie more in their role as early warning signs that help us better prepare for rather than outright prevent a recession. This time could be different, however. The Fed's timely interest rate cuts and other factors, in fact, help to prevent a recession and may help to prevent a recession in late 2019 or 2020. If that happens, we should re-examine indicators that have been successful in signaling recessions in the past. Meantime, do not dismiss what's going on. Why are interest rates down? Well, this is a commentary there. It says, this certainly is an interesting study and runs in sharp contrast to recent Fed statements that the economy is sound. So we're being told everything is great, but the indicators are showing us a little different story there. It is also in contrast to those who suggest lower interest rates will revive housing. We have seen that's not the case. Rates have been low. It hasn't spurred that much new buying and new home sales as well. And rather, rates are down precisely because the economy is weakening, not because it's strong. So there you go from that perspective. These are all going to tie together, these articles. That's why I've sort of put them in a specific order. Subprime will be back with a vengeance in 2020. So if you have poor credit and interest in a home that is above your pay grade, guess what? You have no fear. The Moody's Investor Service is out with a new report that predicts mortgage lenders will loosen their lending standards. In 2020, it is anticipated to be a lot easier for borrowers with bad credit to purchase a house as financial institutions attempt to offset the decline in affordable housing options. So just as we always talk about this, prices may not go down, but rates go down, so your purchasing power increases. The home's not that much more, is not affordable, more affordable. They didn't drop their price. You just were able to get a better rate so you could buy more. They say, I guess you could say, go up in a pay grade essentially because of a lower rate. So interesting. There will be a high percentage of loans with limited or alternative documentation. The fear is what they call the liar loans, the no-doc loans back in the day. We're probably not going to see stuff like that. But again, there will be a high percentage of loans with limited or alternative documentation. And here's what happened in the last housing crisis, which is happening now, is that this means that a lot of new originators and issuers will set up shop and conduct transactions that are supported by closed and second mortgages, home equity lines, and loans backed by manufactured homes. So it's one of those things that and I've already seen it out there, is that okay, you've got your first your primary mortgage, but your loan to value is only so much. Well, guess what? We're going to give you a sort of combined second mortgage that's going to pay the difference. So essentially, you're not putting any money down. We're going to see a lot more of those sort of I don't call them funky loans, but creative loans coming into play, so people can actually buy the homes without money down, which to me in turn means no risk, which means it's not that big a deal if you step away from your mortgage at some point in time in the future. By just closing that loan, you're already underwater if you have to sell the property. So to me, that's problematic. Now, when you factor in banks lowering their down payment requirements, Fannie Mae and Freddie Mae scooping up greater mortgages, the prognostications are most likely accurate, plus the increase in number of consumers slipping to the subprime category has been steadily going up. Deutsche Bank showed a drop in credit scores for borrowers between ages 30 and 59. So our credit scores are dropping. More people are falling into subprime category for loans. Subprime, loosened standards, and mortgage-backed securities. It's all 2006 all over again. So there you go, guys. This is what's going to happen. We have non-banks. We have, I look every day and I see somebody offering, down payment assistance, or again, the combination of first and second mortgage to get you in the door for that home. So as prices, still are fairly high. So these are issues that I think are not good for the housing market, which brings us to a report which I found on DS News. And I've actually been sort of keeping this for the past number of weeks. I wanted to talk about it at the right time. And it really is, it's called the third wave of post-recession distress. So we want to take a look at what the post-recession is, the Great Recession of 2008. That'll be our demarcation point there. And the reason why this was written is because there is an increase in foreclosure filings and foreclosure activity. So as much as we have, decent property appreciation over the past 5 or 6 years, we are 15% above, the 2006 peak according to Shiller across the board. We still have an increase in foreclosure filings. It ebbs and flows, but it's actually getting there. It's not really spoken about. So they basically are saying foreclosure auction inflow data points to a third wave of post-recession distress building in late 2019 and early 2020. So we're here right now. Essentially, a total of 43,000 residential properties nationwide were referred to auction.com in Q3 2019 for a potential future foreclosure auction, up from the previous quarter and a year ago at the highest level since Q1 2017. So you have to look at it and go, okay, well, why are we seeing this happening now? If we're 15% above the peak, if apparently, job growth, unemployment is great, why are more people having foreclosures filed against them? There's obviously something when you start peeling back the onion, what's going on. So you got to look into that. So basically, this foreshadows what's going to happen in the future. So I said it's the third wave of post-recession distress. So I want to talk about this. So the first and largest wave, what they state was comprised of primarily risky loans, cash out refis that originated during the 2004-2008 scene, and we know that a lot of these helped bring on the housing bust. And if you take a look at that, and that's kind of subsided, obviously, but subsided. But where we are today is that in the past few years, loans that originated between 2004 and 2008 were accounting for 40% of all the inflow so far in 2019. So people who got their loans and got their, bought their properties back during that sort of time frame of growth and distress are now actually that number of people who are falling to foreclosure is growing, and that's at a 40% pace, which is kind of big. The second post-recession wave of distress sort of emerged in 2017-18 because of what we'll call natural disasters. So you've got the results of flooding and hurricanes in Texas and parts of Florida. You've got wildfires happening now. You've got issues in Puerto Rico with hurricanes and earthquakes, whatever. So basically we're going to see some of that. Typically what will happen is the lenders will sort of say, okay, you're not paying your mortgage. We get it because of the disaster. We're going to maybe give you a year of forbearance, which means they're not going to come after you for not paying your mortgage. When that year's up, you got to pay the mortgage. You don't have it when we're going to file foreclosure. So essentially, this was a secondary wave. And, I can tell you that, especially in Florida, with some of the hurricanes that came by, we didn't really get hit that hard. So, when you take a look at why have certain states increased in their foreclosure filings, as much as people want to blame, I guess you could say blame the natural disasters, when you take a look at, for example, where I am on the west coast of Florida here, all the increases, we didn't have hurricanes landing on our shore, right? We didn't have those issues. They, were a tropical storm grade grazing us, from the central part of the state. So that's where there's some blame going on with natural disasters, which really, in certain locations, you're darn right, there's some serious issues that went on there. But a lot of states, it's being used a little bit as a crutch, which I think is interesting to sort of point out. Now, The default undercurrents right now for the third wave are government insured and privately owned. So more to the point, the emerging third wave of post-recession distress is showing up in parts of Florida and Texas, but is also showing up in markets far removed from Florida and Texas. That's because this wave is less characterized by geographic concentrations of distress, but more characterized by concentrations of distress based on loan type and lender type. So more to the point, the emerging third wave of distress is primarily driven by a rising undercurrent of defaults among government-issued loans and privately held loans. So if we step back a bit here, well, what's been going on with government-issued loans lately? Well, we see, higher, we'll call it loosening lending standards. We see higher debt-to-income ratio, lower down payments. So you have to, as much as, everything's great, we have tighter guidelines. Well, we're not. We're loosening the guidelines as we speak. If you still think that we have tighter guidelines, you got to give your head a shake, because it's not actually happening right now. And now we're starting to see the past couple of years of these issues now cropping up. So, and this again, in its quarterly report to Congress, the U.S. Department of Housing and Urban Development (HUD) has been signaling an expected rise in defaults. In its most recent report covering activity in 3 months ending June 2019, it included the following statement. A close variation has appeared in every quarterly FHA report starting in Q1 2017, likely prompted by record high debt-to-income ratios, declining average credit scores, and a rising shares of loans with down payment assistance in the post-recession housing recovery. All right, so HUD's telling us right there that these government-backed loans that are actually defaulting faster. What I mean by that, a lot of loans are defaulting within 6 months of purchasing. There's an increase. You buy your home in 6 months, you're already defaulting. You shouldn't have probably bought the home in the first place. You shouldn't have been qualified. So it's whatever we've been doing to get people into buying a house, loosening the standards or pushing them to go to higher price points is causing the issues right now. It all works together. So realize that. Inflow of private portfolio loans. Actually, I'll just forget that. That's too confusing. But again, they say rockstar real estate market's not immune. It says among the 2,410 counties with foreclosure auction inflow into auction.com, 870 counties, which is 36%, posted year-over-year increase in foreclosure auction inflow, including Maricopa County, which is Phoenix, Miami-Dade, Los Angeles County, Bexar County, which is San Antonio. Also posting year-over-year increases in foreclosure auction inflow in Q3 were all three counties in the Seattle metro area, King, Pierce, and I don't even know how to say this, Snohomish, and 3 counties in the Denver metro area, Denver, Arapahoe, and Adams as well too. So we're seeing that other locations that have had really high appreciation are starting to pick up the pace in foreclosure filing. So it all kind of ties together. So when you actually take a look at the net effect here, is people are buying homes they probably can't afford. Lenders, the government, whoever you want to call it, whoever's involved, is making it easier for people to get those mortgages. And guess what? Now we're starting to see some erosion in the housing market where I can't pay that anymore. I'm having some difficulty, and these are the reasons why. So we should not be surprised, and this will pick up the pace as time goes on. What they're also saying is larger areas are posting year-over-year increases for the first 9 months of the year, including Atlanta, Orlando, Jacksonville, San Antonio, Seattle, Denver, of course, as I mentioned. A downturn or a recession would strengthen the distress wave. So analysis of delinquency and home price trends within the last 3 recessions shows that on average, delinquency rates spiked 253% from the pre-recession low to the peak during the recession. Now, obviously, it's skewed by the 2008 recession, but still, at 200% plus is a pretty big number here. And when you start looking at mean house prices drop 16% on average. And to that effect, obviously, 2008 skewing that as well too. But the point is, we are stoking the market for this to happen. So if we by creating competition, by having less inventory, by having the powers that be controlling the inventory behind the scenes, we're and people now stretching to buy property, they're overbuying potentially, or they're making their lives difficult by having the high DTI and really trying to just slide under the radar to get it. It will cause future issues for themselves and for the housing market as a whole. So again, this is not me. This is HUD. Again, third wave of post-recession distress. That's why I'm bullish on the fact that I see the foreclosure funds have been increasing every year the past 3 years in various parts, in the majority of parts of Florida, other locations as well. So this is to be expected. Is something to look at for the very near future. Okay, so and sort of going on with that theme here, mortgage rates fall to three-month low. So this week, the average U.S. fixed rate for a 30-year mortgage averaged 3.64%. Basically, this is the what they're saying is that it's 81 basis points below the 4.45% of the same week last year, according to Freddie Mac Primary Mortgage Market Survey. The decline has also brought mortgage rates to lows not seen in 3 months. Mortgage rates fell to the lowest level in 13 weeks as investors sought the quality and safety of the U.S. Treasury fixed income markets, and the drop in mortgage rates combined with the strong labor market should propel a continued rise in home buyer demand. Well, we know the home buyer demand is always there. If rates keep dropping, it allows you to have your buying power increase, as we mentioned. You're probably going to overbuy or get stuff that maybe you shouldn't afford. We'll see how this all ties in with what was stated by HUD with respect to some of these mortgages that are starting to already sort of fall apart. So please keep that in mind. This is interesting. This is the last article we'll talk about today. 277 people a day leave New York. So it boils down to New Yorkers are fleeing the state in droves due to high taxes. The result of an overabundance of homes that few can actually afford. So Bloomberg reports Manhattan's flood of new condos could take 6 years to sell. And this is really interesting. And if you look back at the previous housing crisis, where do things crumble first? They crumble in the megacities, which is San Francisco, New York, and places, and Miami, Chicago. The really big LA, the really big cities tend to show us the signs first because that's just what happens. So ultimately, Manhattan is glutted with even more luxury condos than most apartment shoppers even realize. The borough has over 7,000 unsold newly built units, according to a report by Hallstatt Development. The bulk of those, almost 6,000, haven't even been formally listed for sale, creating a huge under-the-radar shadow inventory. The secret supply is a heavyweight on a market which sales, especially on the higher-end properties, have slowed to a crawl. It would take 74 months, which is just over 6 years, to clear all of Manhattan's unsold units at the pace of contracts that we experienced in 2019. So, this is what happens, right? People build, developers come in, they do gentrification, they're putting up, high rises, they're doing whatever they want to do in the city, and and they do this as the market's sort of on the way to peak. You don't build overnight. It usually takes, time to figure out the zoning, the demolition, the new build, the construction, the sales, the closing. So it's usually a couple year window here. So this is where people get caught, is that they're riding the wave, and then by the time they're ready with their product to sell, that wave is already peaked and crested, and it's on the way down now. So of course, despite the allegedly booming economy, there's little interest in moving to Manhattan. Rather, people have said enough to the taxes, and this is not surprising. New York, California, Illinois, New Jersey are on the same boat. Those are the top 4 states with domestic outmigration. So that's the fact. We've heard about it. We've read about it. It's actually going on right now. I mean, New York is negative 277 a month. Chicago or Illinois negative 161 a month. A day. Excuse me, not a month. These are daily factors. So New York is netting almost 300 people moving out a day. Chicago 161. Looks like LA 201. And whereas other locations are receiving them. So Phoenix plus 200 a day. Dallas plus 212. Orlando plus 137. Tampa plus 143. So we see the shift in the migration, which really is a combination of prices, state and local taxes, everything. Deductions on your deductions on your income tax, things like that. So this is what's happening. So we're seeing these shifts in marketplaces, which to me, people are leaving. Illinois apparently is, it's gone through a massive migration, and it's just, I don't know what's going to happen there. They seem to have a lot of issues. You read more and more about Illinois. So this is just the beginning. We're probably going to see more. So we're seeing real estate shift with respect to where people are going, where they want to live, and we're going to eventually see that's going to cause some serious housing issues in the locations where people are leaving. So please, I would say keep your eyes out for that. So that's why, for me, it's like when it comes down to our market here, price homes are tough to get. Decent homes are tough to get. A lot of rental accommodations required, so people want to buy and hold and work that marketplace. So that's why, I'm getting my hands on properties. Contact me if you want to do deals and figure the stuff out down here, because people are coming to our local marketplace and to our state. It's the nature of what happens in the business. So having said that, I want to thank everybody for the views, likes, and comments. Again, I got a lot on the go, so reach out to me if you're interested in doing this. What the process is, we talk. I send you a non-disclosure agreement, non-circumvention agreement, which basically means you're going to work with me and you're not going to circumvent my process if we get properties for you. So that's what's going on. Again, I'll get back to people who've reached out with respect to real estate training. I do think that you can do both of this, that buy a few, get some training, figure out what's going on in the marketplace here. 2020 is going to be a very, very interesting year. Lots going to happen, so I'm just trying to prepare for it. I've seen the pace pick up since middle of December to where we are today. It's been nonstop action, which is really kind of fun and it's interesting. So reach out to me. We'll be sure to get back to you. But sort of summarizing what I've mentioned here today, what was our number one issues? Well, housing sailing a recession, so the indicators are there. Subprime is back with a vengeance. So, which to me, what is the main issue? Subprime coming back at the peak of the market, and yes, we've seen slowdowns in home price appreciation, so the market is peaking and subprime is back, so it'll maintain for a while before it starts to erode. And the third wave of post-recession distress, it all kind of comes into play. People are buying at the top of the market. They're going in with less down payment, less risk, higher debt to income ratio, so they're spending more on housing. And then guess what's happening? Something changes in their lives and they're defaulting on a faster pace than historically they did before. So keep that in mind, guys. The world's changing. Thanks very much. We'll look forward to speaking with you early next week.